Look, you've been told the AI revolution is about apps, chatbots, and smart assistants. But while you were waiting for ChatGPT to replace your boss, your portfolio just took a massive hit. The brutal reality of 2026 is here. Software is bleeding out, and hardware is absolutely crushing it. Welcome to the Halo trade, the only strategy keeping Wall Street's biggest players from going broke right now. If you're still holding 2023's AI darlings, you're not an investor anymore. You're exit liquidity. Why? Because building AI is insanely expensive, and so far almost nobody is actually making money from the apps. Look at the Capex. Big tech is burning billions of dollars. But where is that money actually going? It's not going to software engineers, it's going to the grid, it's going to the physical world. But there's a hidden bottleneck in this trade that nobody is talking about. A secret ingredient that will make or break your 2026 returns. We're breaking down the 3 reasons why the hardware lead all others, or Halo trade, is the only game in town. First, the picks and shovels rule. During a gold rush, you don't want to be the guy digging for gold. You want to be the guy selling the shovels. In 2026, those shovels are GPUs, liquid cooling, and high-voltage transformers. Companies like Nvidia and Vertiv aren't just participating in the AI boom, they are the gatekeepers of it. Meanwhile, software giants are hitting a wall. They've added AI features, but guess what? Users aren't willing to pay the premium yet. It's the SaaS squeeze. High R&D costs, massive compute bills, but zero expansion in profit margins. It's a nightmare. This brings us to the second pillar of the Halo trade, the power crisis. You can have all the AI software in the world, but if you can't plug it in, it's worthless. Data centers are now consuming power at a rate we've never seen. We're talking about a 300% increase in grid load. This is why boring utility stocks are suddenly mooning like tech stocks. It's all part of the Halo effect. And wait until we talk about the copper crunch. If you think chips are scarce, you haven't seen what's happening to industrial metals. Take a look at Vertiv. 2 years ago, most retail investors couldn't even tell you what they did. They build the cooling systems for AI servers. Without them, the chips melt, literally. While the software index IGV struggled to stay green, Vertiv has been printing millionaires. This isn't luck, it's physics. So, does this mean AI software is dead? Not exactly, but it's entering a survival of the fittest phase. Only the companies with deep moats and proprietary data will survive. The rest? They're just wrappers for OpenAI. Stop buying the AI story. Start buying the AI reality. The reality is made of steel, silicon, and electricity. Let's rank the 4 sectors of the Halo trade so you know exactly where the smart money is rotating next. Ranking at number 2, the hook is energy and utilities. You can't run a 100,000 H100 cluster on a standard grid. Nuclear is back, baby. Companies like Constellation Energy are signing massive deals directly with big tech to power their AI dreams. But the undisputed king, the number 1 spot, is still semiconductors and foundry. You can't bypass the hardware. Whether it's Nvidia, AMD, or custom silicon from Broadcom, this is the toll booth of the internet. While software margins are getting squeezed by compute costs, Nvidia's margins are looking like a luxury brand. They have the pricing power. Number 3. Physical infrastructure. Think racks, cables, and cooling. It sounds boring until you see the order backlogs. Some of these companies have orders booked through 2028. That is guaranteed revenue in a world of uncertainty. And finally, number 4. Industrial metals. Copper is the new oil. Every AI server needs miles of high-quality wiring. There is a supply squeeze coming in copper that makes the 2021 chip shortage look like a joke. Are you prepared? This is the rotation. Capital is leaving the cloud and coming back to Earth. We are seeing a historic shift. The Nasdaq isn't just one big blob anymore. It's splitting into haves and have-nots. You need to decide which side of the trade you're on, the story side or the infrastructure side. Because by the time the software finally figures out how to make a profit, the hardware players will already own the grid. Part 2 Transition. Here is the invisible wall. Big tech is flush with cash, but they can't buy their way out of physics. Software is weightless. But the infrastructure running it? It's heavy, hot, and power-hungry. One single H100 cluster can consume as much electricity as a small city. We're talking megawatts, folks. This is where the halo trade gets real. If the grid says no, your fancy AI software is just a dead link. But wait until you see which state is literally running out of juice because of data centers. You won't believe it. Companies that manage power flow like Eaton and Schneider are the new kings of the Nasdaq. Their backlogs are exploding. While SaaS companies are begging for subscribers, these guys are turning customers away. When you have a 2-year waiting list for a transformer, you don't need a marketing budget. You have pricing power. These aren't just boring industrials. These are the life support systems for the digital age. Investors are finally realizing AI is a commodity, but the ability to run AI is a luxury. Look at the Microsoft Constellation deal. They are literally resurrecting a nuclear reactor at 3 Mile Island. Why? Because big tech is desperate for always-on carbon-free power. They need the juice at any cost. This sent CEG stock to the moon, a utility stock. In 2026, megawatts are more valuable than monthly active users. Solar and wind are great, but AI needs 24/7 reliability. That means nuclear and natural gas are the real winners. And time is running out. The queue to connect a new data center to the grid is now 5 to 7 years in some regions. If you're waiting for software to save your portfolio, you might be waiting for a train that isn't coming. But there's an even bigger bottleneck underground, a red metal that's about to become the most hated shortage of the decade. Welcome to the copper squeeze. Every GPU, every server, every transformer needs miles of copper wiring. An AI data center uses 3 to 4 times more copper than a traditional one. The math is brutal. We are looking at a massive supply deficit by 2027. We haven't built enough new mines to keep up. That's why companies like Freeport-McMoRan are starting to trade like tech startups. They own the raw reality. You can't code more copper. You have to dig it out of the ground. That takes a decade. While software can be copied for free, every pound of copper is a battle. This is the ultimate moat. Now, let's talk about the heat problem. AI chips run hot, like melting point hot. Traditional fans can't handle it anymore. The industry is moving to liquid cooling. This is a total hardware reset. This is why Vertiv has a monopoly on the lungs of the AI industry. No cooling, no AI, period. The market for liquid cooling is expected to grow at a 25% CAGR. Compare that to your favorite SaaS app. But is the Halo trade too crowded? Is there a trap waiting for investors who join the party too late? Wall Street loves a good story until it becomes a crowded trade. Let's look at the risks. Investors are starting to ask, when do we see the return on this $100 billion investment? If big tech pulls back on spending even a little, the hardware companies will feel it instantly. But here's the kicker. They can't pull back. It's an arms race. If they stop buying chips, they lose the future. It's a prisoner's dilemma on a trillion-dollar scale. They are forced to keep printing money for hardware. And that is why the Halo trade is the most resilient play in this market cycle. Money is moving from hope, software, to physicality, hardware. It's a return to industrial sanity. You don't need to find the next Google. You just need to find the guys building Google's engine room. Coming up, I'm going to show you the one metric that tells you exactly when to exit the Halo trade. Most people will miss this signal and get caught in the 2027 hardware glut. Don't let that be you. Success in 2026 isn't about being smart. It's about being early to the rotation. The Halo effect is just beginning. The question is, are you holding the software bags or the hardware keys? Part 3. But don't get too comfortable. Every supercycle has a hangover. And for the Halo trade, it starts with Capex fatigue. If Meta or Google decides to cut their AI budget by even 10%, the shockwaves will hit hardware stocks like a freight train. We've seen this movie before. Over-ordering leads to inventory gluts. Too many chips, not enough buyers. Right now, demand is a monster. But supply is catching up. The moment that balance tips, you need to be at the exit. Remember that one metric I promised? It's the inventory to sales ratio for Tier 1 cloud providers. When Amazon and Microsoft start sitting on unused chip capacity, the hardware premium vanishes overnight. Watch that data like a hawk. The big boys are already watching it. They won't tell you when they sell. They need you to buy their bags. Don't be the last one at the party. In the halo trade, being right but late is the same as being wrong. 2026 feels a lot like 2021, but with real assets. The hype is the same, but the underlying collateral is different. Even copper has its limits. If the global economy slows down, all that infrastructure spending becomes a liability. Stop chasing these $2 AI penny stocks. They are just lottery tickets with worse odds. Stick to the kings of the grid. If they are bleeding, the whole market is dying. Sector rotation is a zero-sum game. For hardware to win, software had to die. And it did. Will software ever come back? Sure, when they figure out how to make $1 for every $10 they spend. The next wave will be lean AI apps that don't need a supercomputer to run a simple query. But we aren't there yet. And there's one more black swan event brewing in the Taiwan Strait that could end the halo trade in 24 hours. Geopolitics is the ultimate hardware risk. 90% of the world's advanced chips come from one tiny island. You aren't just betting on technology, you're betting on peace. Make sure your portfolio can handle a hardware shock. Hedging isn't for cowards, it's for people who want to stay in the game. Look at defense stocks as a halo hedge. The halo trade is the greatest wealth transfer of the decade. It's taking money from cloud dreamers and giving it to grid builders. So, to recap, buy the shovels, watch the grid, and don't ignore the raw materials. The AI revolution is physical. It's loud, it's expensive, and it's made of copper and silicon. If you understand this, you aren't just an investor, you're a strategist, and the strategists are the only ones getting rich in 2026. The gap between the digital and physical worlds has closed. This is the halo era. Don't let your neighbor get the edge on you. Information is the only asset that doesn't have a supply squeeze. Subscribe to level up your finance game beyond your neighbors.